What's up, everyone? It's Scotty with MoneyVest. In this video, I wanted to break down the inflation numbers for the month of October. So I'm going to give you my thoughts and my opinion on the inflation numbers, and also go over some of the unfortunate truths about inflation, right? Which I think a lot of people need to understand how inflation really works and what perception can do to overall market expectations and inflation expectations. So hope you all enjoy this video and find it helpful. Make sure that you drop a like. I would really appreciate it. And of course, subscribe to the channel if you haven't already. You know, your subscription and your like really helps out with the channel, and the algorithm kind of pushes this video out to other people as well. So I would really appreciate that. And if you want to join and be a part of our MoneyVest community, link's going to be down below. You get access to over 40 plus members only private videos, as well as Excel spreadsheets with a lot of data sets and data-driven research and analysis. And of course, over 20 plus Discord channels, including trade alerts, trade ideas, options. Everything's going to be included with the link down below. There is a 16% annual discount that's available till the end of this month. And there's, I think, a couple more spots left if you're interested in joining. So let's go over to the report for the month of October. So look, we came in very, very good in terms of the month-over-month change. So literally no change on headline inflation, so 0.0%. And this right here is what's very, very good, right? In terms of when you look at these numbers on the surface, they look like, wow. I mean, inflation's down from like 8% year over year or 9% year over year. We're now down to like sub 4%, sub 3%. So all items CPI sitting at 3.2. We've got, all items less food and energy. So basically core inflation sitting at around 4%. That's fantastic. Month over month, we only increased by 0.1% or 0.3% for all items. So that's phenomenal numbers here. These are the consensus. And this is where we ended up printing, which was lower, 10 basis points lower compared to all consensus here, which again is a bullish reaction. We talked about this during our live stream yesterday, that if the numbers come in better or softer than what the expectations are, that is going to be very well received from the market, and that could spark a very nice potential bullish rally, and that's exactly what happened, right? We came in, no change on headline, 3.2 on a year-over-year basis, lower than consensus, 0.2% for core, lower than consensus, and hitting right on 4% on core inflation as well. Now, what I really want to address in this video also is how inflation really works, right? So if you come over to the overall index of CPI, right? And the reason why I believe that when it comes to interest rates, right, this is the federal funds rate, and right now we're sitting at well over 5.33%, and that's exactly the whole idea behind the Federal Reserve's battle against inflation, that they've been raising interest rates for such a long time, well over a year. They've been raising them for over 500 basis points. It's the most aggressive tightening cycle that we've ever witnessed in a very long time. And the reason why I believe that 0% interest rates are long gone, are gone for good, unless there's a very, very severe depression or if there's a very severe deflation risk. If those two things don't happen, I do strongly believe that 0% interest rates are going to be gone for a very long time, meaning that, the freedom that we had here in these times. So for example, you'll notice since 2009 all the way till 2015, so that's 6-year period, and even you could argue like up until 2017, so that 8-year period where interest rates were sub 1%, and then of course getting cut back down in 2020, and then spending below 1% for a very long time. For another 3 years, they were at sub 1%. I think these times are long gone, and I'll go over exactly why that is. But let's just dive right into CPI first, right? This is the CPI index, okay? The number that's quoted on these inflation reports, and like for example over here, the thing that we see 3.2%, 4% is only a year-over-year number, right? So if I go over to month-over-month, what you'll notice is that this is the month-over-month change, right? Which was in October, it shows negative 0.04%. That's why when you're rounding up, it says 0.0%, basically no change in prices on a month-over-month basis. That's great. But if you take a look at year over year, this is the number that's being quoted. So you can see 3.2% in October. That's going to be this number right here, 3.2% on a year-over-year basis for headline inflation. Now, the problem with this is that many people would look at this 3.2% and be like, wow, it's down significantly from highs of 9% from June 2022, right? So we were significantly higher in June, and we are now significantly lower. So on a year-over-year basis, this is fantastic. And you'd be right to think about it that way. However, the problem is that prices in general are up, right? So this is the CPI index that I want everyone to also focus on, because if you take a look at August 2023, we are now sitting for this index at 307.79. And this is what really tells us about that year-over-year increase. So what this is going to do is this is going to compare the index for September of 2023 versus September of last year, and then look at that growth. And if that growth is 3% or 2%, that's what the Federal Reserve is trying to target. They're trying to target 2% growth in prices on a year-over-year basis. But of course, it often gets lost in translation because many people forget that prices in general, overall, are still going up. So not only are we in an environment where interest rates are higher, we're also in an environment where prices continue to go higher, right? Yes, the rate of increase is slowing down. That's what the year-over-year number represents. But overall index of prices in CPI is still higher. And the reason why I believe that interest rates are long gone are those days for 0%, is because there is little to no deflation risk in the economy. Even though we know that Jeremy Siegel and Cathie Wood and a lot of people have been very vocal about a potential deflation risk, there's not been any signs, any clear indicators of whether we're going to see one or not. And it's usually when there is significant amount of deflation risk, meaning prices are going down. So when you start to see this index roll over, right? When we start to see this 307 go down to 306 or 305 or 300 or sub 200, sub 300 again, that's when the problem becomes a bit more challenging. Believe it or not, deflation is a much bigger risk than inflation or stagflation. Because in a deflationary economy, you're not really seeing any spending whatsoever. Like, people are literally not spending, and as a result, demand is gone, right, for good, and prices are dropping like hotcakes, and as a result, earnings struggle, unemployment skyrockets. So deflation ends up being a bigger risk to the economy than actual inflation or stagflation, and there is no deflation in sight. I mean, we've seen a couple times in 2008. We saw it a little bit here in 2014, maybe just a little bit in 2020 as well. But all of these times, of course, the Federal Reserve ended up doing what? They ended up lowering interest rates significantly to cut them down to under 1%. But in my opinion, just given how much money supply there is, given how fiscal deficits continue to rack up on these higher interest rates, and consumer continues to take on so much debt, and the economy is super strong and super resilient, very, very unlikely that we start to see prices roll over to a point where there is actual deflation. It's possible, but the probability is quite low. And for that very reason, I think it's going to be very challenging for the Federal Reserve to once again prioritize lowering interest rates back down to sub 1%, basically, or close to 0%, as we have already seen in the past. Now, one more thing I want to point out is that Jerome Powell and the Federal Reserve has already mentioned what their priorities are, right? They are going to focus more on inflation and bringing inflation down than focusing on fighting a recession or fighting a rise in unemployment. Because in the past, you'll notice that interest rates have almost always been cut when there's even the slightest of probabilities of a recession, or when there's economic contraction or unemployment starting to go up. And what that's done to inflation is obviously push it back higher. So you can see that, in 1970s, interest rates went down because of a recession. Interest rates getting cut in 1974 because of a recession. This right here in the 1980s, double dip recession, interest rates getting cut both times. So the Federal Reserve has really, at least in my opinion, have learned their lessons from the past, that they don't want to lower interest rates just to fight it for recession. What their main focus is going to be moderating the growth on a year-over-year basis for inflation and for prices to increase by 2%. And that's exactly why it's 2% target, right? Lots of people also wonder sometimes, why 2%? Why do we want to see prices go up in the first place? Well, like I said, deflation is a much bigger risk compared to inflation. And 2% is a very modest increase in prices, which is going to happen over a long period of time. And that's why this index continues to move higher. Now, this is a more modest growth. As you can see, 1960s, 70s, much modest, far more modest growth. But as soon as interest rates getting cut here, you can see the parabolic move. Both times when interest rates get cut significantly, you can see in the screenshot how quickly the prices increase with respect to the demand here. Boom. Like, this is a more parabolic move. Over here, you can see a more parabolic move when interest rates absolutely get cut down to 0%. And for this very reason, I do strongly believe that the Federal Reserve is now finally coming around to the idea what 0% interest rates can do to the economy and to the prices. And for that very reason, I strongly believe that I think those days are going to be somewhat gone for a very, very long time, unless there is a significant amount of deflation risk where this price basically starts to, fall flat moving forward and then starts to come down. That's when I think interest rates are going to get cut down to 0% to stimulate that economic growth and that demand once again. So that's where we are. But look, bottom line, I mean, markets are cheering on this year-over-year decline in inflation, and rightly so, because we are starting to see some moderation in prices on a year-over-year basis. But like I said, I mean, prices in general are still higher. It's just the rate of increase that is slowing down from 9% down to 3.23% on a year-over-year basis. So that's really where we are. And of course, yields are dropping on the back of expected cuts, on the back of lower inflation prints, and markets here again very, very risk on at the moment. But I think we still need to be very cautiously optimistic, just given the fact that we are a little bit more on the overbought side at the moment. So hope you guys enjoyed this video. Just wanted to break down the entire sort of landscape. And again, you can see a lot of the prices coming down on a year-over-year basis. So for example, shelter prices really rotating back lower. Again, shelter prices are overall up, but the rate of increase is now slowing down on a year-over-year basis. This right here is going to be food, also coming down pretty dramatically. So 3.7%. The last time we were actually in deflation was back in 2009. So I don't think it's gonna be that's gonna be the case this time around. And then finally, we've got energy prices that obviously did see a significant increase. Then we saw deflation. Then we pushed back higher above almost that 0% range, and we're now rotating back lower to negative 4.5% because we did talk about how energy prices, oil prices are down in the month of October. So I hope you guys enjoyed this video. Don't forget, join our Discord Patreon for a lot of detailed analysis, money invest intrinsic values, retirement calculators, debt calculators, S&P 500 valuation, volatility spreadsheets, members only private videos, Discord channels, and alerts and trade ideas. Everything's going to be included. As always, make sure that you drop a like, subscribe to the channel. Link to our Discord Patreon is going to be down below. 16% annual discount that does expire at the end of this month. Happy investing. I'll see you all in the next video.